So regardless of what the Bank of England are saying, or indeed all the central banks, is the reality, in fact, interest rates are going to come down much quicker than everybody expects? And what will that have as an impact in terms of the property market in the UK, both the residential and the commercial market? So we're going to dive into that in this video. But first of all, I want to tell you a story about something that happened this week. So, or over last week, to be honest. I was up in Chester. As you know, right now we're in a development in Chester where we are refurbing a block of 4 flats and a commercial unit, which I bought about sort of 6 months ago now. And we're pretty much coming to the end of that. So we're going through a refinance. In fact, we're going through a portfolio finance to acquire another property that we've had through legals for the last few months, again, up in the Northwest. So as I was walking around and speaking to the surveyor, I was trying to get a gauge of where they're looking at valuing property right now, based on commercial valuation, so based on a yield valuation. Now, of course, it figures that if interest rates are high, if yields are high, then they're going to apply a higher yield to the valuation process, and yields are inverse to value. We've spoken about, if anybody has been on the lives previously, we talk about the inverse relationship between yields and value, especially with things like bonds. It's exactly the same in commercial property or things that are getting a commercial valuation. So I was somewhat surprised when the surveyor said that he's probably looking for commercial property in Chester. And don't get me wrong, middle of Chester is a pretty decent area. But he was sort of talking about 8.5% to 9% yield, which to me was quite a lot lower than I was expecting. I was expecting to say somewhere between 9.5% to 10%. And that to me shows that he's actually quite bullish in terms of valuation. So the yield expectation was lower in his mind than I was expecting. When we talked about the residential element, he actually said that residential element would probably be commanding a 6 to 6.5% yield, which again, I thought was fairly bullish in terms of the valuation. Now, does this mean we're seeing a shift in expectation of where interest rates are going? And of course, if interest rates are going down, yields will be going down and values of assets will be going up if you apply a commercial valuation. Now, when we follow this through logically, this is a good thing if we're holding or buying depressed property now, because in the future, we might be seeing a reversal. And I say might, because we're going to look at the data behind it. We might be seeing a reversal in terms of asset prices over the next couple of years. Now, this has all been sort of triggered from, or this live has been triggered from a report I read today saying, are we about to see the central bank set to pivot? Are we actually going to see interest rate cuts come sooner than the central banks are saying? The Bank of England have said, don't expect anything in 2024, whereas the markets are clearly pricing in interest rate cuts more quickly than that. And in the US, of course, we're starting to price in, or have been, and I'm going to talk about today's events as we go through this. So hang on for that. We'll talk about what's changed, maybe the trajectory today. But over the last week or so, I've been talking about interest rates expectations come down much more quickly, potentially even start to cut in March 2024. And I'm talking about the Fed here. I'm not talking about the Bank of England. And the effect that's been having on the value of bonds and yields, et cetera, et cetera. Okay, so are we going to see this? But before we talk about interest rates and the path of that, I do want to address the Halifax HPI, House Price Index, which came out a few days ago. And I know there's probably been lots of other people talking about this in the YouTube space already. I just want to give you my spin on it. Before we do, we are live. So if you can see and hear me, I haven't actually said this yet. Please give me a thumbs up if you can see and hear me, and find the comments. Put something in the comments so I know that everything is going out all right. When we talk about interest rates in this session, I would like to stimulate thought and stimulate conversation, because there is no right or wrong. There's no right or wrong answer here. Okay, so I want to, in fact, let's come here. I want to stimulate discussion. So I'm going to throw out some data. I'm going to talk about some potentially conflicting data, and I want to get into discussion points. If you're watching on the live, we can talk about it. If you're watching on the replay, put your thoughts in the comments and we'll get back onto it. And by the way, welcome to everybody who's joined the channel recently. It's great to have you on these live streams. My aim is to look through data to understand what's actually going on underneath the headlines that we see thrown out. Okay, and that's what we're going to do today, and it's no different. So it is my birthday, so I thought I would share my birthday with you guys today. My camera has got a habit of doing stuff. I don't know if that's going to create, oh no, it's a different camera. When I put a thumbs up on a different camera, it creates all these like weird effects, which is quite annoying. But anyway, happy birthday to me. Let's crack on with it. So Halifax HPI, yes. We have seen Nationwide last week talk about UK property price increases of 0.2% seasonally adjusted. Halifax has come in and said 0.5%. Now, the difference between the Nationwide and the Halifax is that the Nationwide actually saw a property drop, okay, but they seasonally adjusted it with a much bigger seasonal adjustment, which put a 0.2% up. Halifax has actually shown a real-time increase. And of course, the moment we get, a deviation from anything, we see property price going up. There's lots of comments about, look, told you, no property crash. Property prices still going up. It's all good. I just want to put my stall out as always and say, I do not have a bias either way. I do not have an agenda either way. I'm not one of these people who says, I want to crash because I want to buy my house cheap, I want property prices to go up to prove everybody wrong. All we do is look at the data, okay? If we actually if we actually zoom out, okay, and look at the chart, and this is why I always say, don't get too worried about monthly upticks or downticks. The monthly data is fairly irrelevant. We always want to zoom out and look at the trend lines, okay? And I always talk about charting. I'm not a chartist, and I do not even know if the theory behind charts goes from things like a more liquid environment with stocks and shares versus property. But I always do just like to look at the trend lines, okay? And if we look at the Halifax, effectively, the way I see this is we are in a channel right now, which is a down channel. And until we see something break out of that channel, right, the trend is still down. So even though we've seen a couple of months of uptick, the overall trend when we zoom out is down. If we see this line, okay, break above this trend and come up, then we can safely say we've seen a reversal. Until we get to that point, we can't, because we could hit this and then we come back down again. So we've just got to let this play out. The problem with property is that the trends take literally years to manifest, and it's very difficult to call it. It's not like, we're charting a share and going, it's about to break out, put your money in because it's going to go up, or, take your money out, it's going to go down, or short it, or whatever. The property market doesn't work like that. There's such a lack of liquidity in it. We're always looking in the rearview mirror here, right? And don't forget that this is one HPI out of many. This is purely done on mortgage value. And the way that the models work, hedonic regression model, they have a whole load of factors that go into this bucket with different weightings on. And there's lots of things when we've got a much more constricted property market, which we do right now. And I'm not going to go into all of that data. We did that last week. We'll look at December's over the next few weeks. When you've got a much smaller data set, it's much easier to see skews in this data, right? So let's just sit on our hands, zoom out, and see where the long-term trend is taking us. For me, it's still down. Good. Right, let's establish that. So we're now going to talk about interest rates and the potential path of interest rates. Before we do, I want to give you a 30-second message about why I do this channel and how you can help support that. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. So please do hit that subscribe button now if you are not subscribed, so you can make sure we get all future broadcasts. Okay, so look, let's talk about interest rates. Before we do, I'll throw it out to the floor on the live and on if you're watching on the recording. What's your expectation of interest rates over the next 12 months? Where do you think we are heading and why? I would love to know your thoughts on it, because we have a very, I've said it for about a month now. I feel we're at an inflection point, and there's no clear direction of exactly where we're going to be going. We have this standoff, or this narrative that is Bank of England or central banks conflicting with markets. Central banks staying higher for longer. There's now this phrase that has been termed table mountain, where we're not going to go any higher, but we're going to stay high for a long time, versus market expectation. I can see we've got questions, some questions in here about, do I think that media is perpetuating this? What I'll do is I'll go through the slides and then we'll have a discussion about it after we've gone through the slides. So this came out from Nationwide's HPI last week, which was a market implied path for interest rates. You can see that the blue line at the bottom is effectively the current line of where the market implied path is, significantly lower than the last 3 months before it. So the expectation continues to be set by the markets that we are going to be dropping more quickly than people thought, or coming down more quickly than people thought. If we look at, this is today's swap rates, okay? If we look at the 5-year swap rate, which is the one that I usually like to look at in terms of the effect of mortgage lending, so 5-year fix is probably one of the more popular products. So generally looking at 2 and 5. For the first time, and I haven't looked at this for a few days, so it's obviously popped down a couple of days ago, we are below 4% for the first time on the 5-year swap rate. Actually, yesterday we were 3.9, so it obviously came down below 4 recently. So again, the swap rates continue to come down and we're now sub 4%. We'll be interested to see where that goes. However, I think it's really interesting not just looking or getting focused or fixated on the 2 and the 5, but looking longer term where we are going. And I also like to chart, or not chart, but look at the delta, i.e. the difference between where we are now on different timeframes and where we were, say, last month or a year ago. So something that's quite interesting is if we look at the difference between the 7-year or the 10-year, okay, we're actually seeing the longer term expectation are dropping less than the shorter term expectation, if that makes sense. So we're 3.9 on the 5-year, on the 10-year, we're 3.7. Okay, so actually it's not coming down much after that. Now we're obviously at 5.25% right now. So the markets are expecting us to be, on average for the next 5 years, a decent amount below the 5.25% we are now. Okay, if we sit at 5.25 for the next year or so, over a 5-year period, we've got to go, obviously below 3.9 the other side and sit there, sort of low threes to hit a average of 3.9% over the next 5 years. But yeah, sorry, if we look at the delta, we can see that a year ago, 7th of December 2022, the 5-year expectation was 3.66 and we're now at 3.96. So it's a 0.3% difference from a year ago. Let's just look at the 10-year here quickly. So the 10-year, we were at 3.19%. And now we're at 3.781%. So that's what's that? It's a 0.7% difference. So in terms of percentages, okay, we're actually, a fair amount difference in terms of the longer term 10-year plus projections than we were a year ago. So what that is saying is the market considers that we're probably going to come down more quickly, or we're coming down quickly over the next, 2, 3, 4, 5 years. But then we're not. Then we're going to stall in terms of longer term interest rates. So that's something we need to bear in mind, okay? But anyway, let's just go for the present right now because the markets are very reactive. So when we have a look at those markets, this is the 10-year gilt. We can see again, we've come down fairly rapidly over, where's that? So we peaked September. Since beginning of November, we've come down fairly rapidly. We've got a little uptick here. We'll talk about the uptick in a sec. If you hold on, we'll talk about some of the reasons between that uptick, but we've seen the gilts come down. The gilt yields come down, which means, again, bond values have been going back up. And here's our current yield curve. So if anybody's into yield curves, we can get an expectation of where the market or the economies or interest rates are going with something called a yield curve. Very, very simply, okay, a normal yield curve would be something like that. So sloping up from left to right, which effectively means people or investors would expect a greater return from locking their money up for a longer period of time to offset inflation, offset unexpected events. However, you can see very clearly we're in an inverted yield curve, which means investors believe, or the market believes, that interest rates are not going to be going up anymore. They're going to be coming down in the short term. Now, I say short term. This is actually 2 to 6 year, 6 year percent. 2 to 6 year time frame, but effectively the market saying we are coming down. We don't know about the rate, but we are coming down. Okay, so we've been inverted for a while now. I'm no expert on yield curves. I've got to be honest. I'm a basic sort of economist when we look at this sort of thing. But if we see that this yield curve flatten off, so when we get to the bottom of, let's say we suddenly get rid of that, right, and then we're here. very often when you look back through history, that is an indication of us going into recession. So very often an inverted yield curve means we could be heading to recession, and then we're in recession when it sort of flip-flops. Why do people think that, or why is that an expectation? We're at a higher interest rate than we've been for 15 years. The main driver of interest rates coming down quickly would be going into a recession, where you've got to dial back that tightening regime and go back to easing to stop grinding the economy when it enters recession, okay? So when we're in recession, you're not going to be expecting interest rates to go up at that stage. Sorry, when you're going into recession, you're not expecting them to come down much more because they've probably already been ratcheted down, right? So longer term, you're then going to be going back to interest rates going up over the longer term period as we come out of recession. I hope that makes sense. So all the indicators are the market saying we are coming down, and we're coming down quicker than we expected. Interestingly, I found this in the same article as this article this morning, Central Bank Sent to Pivot. At the end of it was a Guru Watch excerpt from a Jim Rogers. I've got to be honest, I don't know Jim, but apparently he's a former hedge fund manager who co-founded Quantum with George Soros in the 1970s. This is what he says. I'm just going to highlight this, because I think there is an expectation of, on a very binary level, us as UK people go, interest rates up is bad, interest rates down is good, right? Interest rates come down, property market is just going to be released. It's not as simple as that. So he says, and I'll read this, I suspect in the next year or two, we'll see some kind of major problems, longer term problems in the world financial markets. Okay, last time, well, we were talking a few months ago, maybe 6 months ago, about potential credit crunch, potential bank crisis with, if you remember, Silicon Valley Bank went down. There was some systemic issues in some of the smaller banks over in the US, depending on who they're lending with. Higher interest rates were causing them to have to, the value of their bond portfolios to drop, and they're having to liquidate them for liquidity reasons because people were asking for their money. And that, of course, made banks like Silicon Valley Bank go under. The last major global issue was clearly 2008. Okay, what happened in 2008? Some black swan event happens. Generally, what's going to happen if that sort of impacts across the whole world is we're going to have to save the day with reducing interest rates, going back to money printing, QE, quantitative easing. So he goes on to talk about, I'll just, again, let me highlight this here, where he says, probably the best place to put your money if you want to invest anywhere right now, because governments, and I quote, when they print money, you protect yourself by holding real assets. Okay, silver and sugar are down. So I'm not going to go into commodities. He's talking here about the potential in the next couple of years about there being a global financial systemic issue, which could, either take us into recession. Therefore, we see quite a rapid unraveling of the QT program. We go back to QE, which is interest rates coming down, money printing going on. And we talked about this a couple of weeks ago, that when we look at all the scenarios, there is a scenario of everything getting quite nasty quite quickly and having to reverse that policy. Okay. Obviously, if we go into a quick reversal from QT to QE, that's going to have an impact on certain asset prices. One of them, I believe, being property, because the moment you start going to QE, putting money into the system, right, and interest rates coming down, it's going to release, not immediately. You probably see, if you go back to 2008, it's probably a few years of flatline, but then with money in the system, you're going to see those asset prices come on. So that's a scenario that is potentially there. I'd love to know what you think about that scenario. And that is a scenario. I'm not saying it's going to happen. I'm just saying it's a potential scenario, and it's one we covered a couple of weeks ago. So is there a potential scenario where we could find ourselves seeing interest rates drop very quickly, reversal of policy from QT back to QE, which leads to effectively, let's face it, QE happens, it's just going to be massively inflationary, because if this happens, the actual core underlying issues that have caused the inflation in the first place are probably not resolved, right? And then you look at geopolitical issues in Middle East, in Ukraine. Would that then push us back into a high inflation environment, and we've got to ratchet the interest rates back up again over a medium term? Is that what the markets are suggesting could potentially happen with the yield curves as they are? And if that is the case, how will that have an impact on us as property people, property investors, or indeed any sort of investor, or indeed any sort of business owner, okay, that is relying on debt to buy or grow businesses. Interestingly, in the narrative here, and I actually can't remember what publication this was from. I think it could be, I have an Apple subscription, which just kind of collates all of this for me. So I can't remember where this is actually from. The author talks about his belief that we've obviously been in a unnaturally and unhealthily low interest rate environment for so long, for the last 15 years, which of course promotes people to grow through debt, rather than potentially through equity investment. And debt investment could be often a deck of cards where you're propping everything with debt. The moment we see interest rates go up, like we've done, you know the phrase, when the tide comes out, you see who's been swimming naked. When it reverses, it causes a lot of issues because there's so much debt in the system that's now, we now can't service. Anyway, we'll kind of digress with that. And another thing I'm going to be talking about probably the new year is, how do we re-stimulate growth in the UK, which is not looking particularly clever right now. So anyway, how will this happen with property? Well, if interest rates do come down, right, inevitably, it probably will stimulate the housing market. We talk about the residential housing market. I've shown this graphic a few times. This is literally maths about what you can afford, what people can afford, versus property prices. So property prices are generally not dictated by value. They're dictated what people can afford to borrow to buy them. And if you can borrow money at different interest rates, you can borrow more money if the interest rates are lower, and still pay the same amount in terms of monthly outgoing. So therefore you can pay more, and therefore the property market carries on its cycle of going up. We'll talk about the issue of, if interest rates are coming down quickly, is that because we're going into a horrible recession, right, or economy meltdown, and that's going to negatively affect property prices. Another thing, and this is more interesting for me, is the effect on commercial property, because I do view commercial property very much like a physical asset, like gold, like silver. It's valued in a different way. It's valued like a bond is valued, on a yield basis. And therefore, we have seen over the last 18 months, the value of commercial property dive significantly because of the high interest rate environment and the systemic differences in commercial versus residential, which is very much more that it's variable rate lending. So those changes in interest rates feed through very quickly. Right now, I've been saying for about the last 6 months, and I think into next year, one of the biggest opportunities in property is that commercial space where we're buying very depressed commercial properties. And when I say commercial, it doesn't have to be massive office blocks. It could be, B&Bs, guest houses, anything really that's not residential. And we're buying at a very depressed price per square foot. And then you arbitrage that into the residential space by converting through committed development, many other things. Will we see a reversal in that? Do we see commercial property hitting a trough? And therefore, are we now in a very definite entry point into that market to accumulate for the next 2 years? And if interest rates come down, by definition, just the interest rates coming down will change the valuation profile of commercial property. Could that be a fantastic opportunity over the next 2 years? I believe it is. I'll give you a link to the white paper where I talk about how you can leverage that opportunity in a bit. But before we do, let's just continue on the narrative. And by the way, I said at the beginning, I want to re-clarify now. On this session, on this live stream, I am purposefully throwing out some concepts, some theories, some hypotheses about what might happen. I'm not for one moment saying this is definitely going to happen, because I feel there is a balancing act going on with the push-pull factors, and I don't know which way it's going to go, which is why nobody knows which way it's going to go, which is why all we can do is look at the trends. I want to stimulate some discussion here about where you think this could go and how this could pan out over the next six months. I think the next 6 months will give us a very definite direction of where we're going, into Q2 2024. So yes, as I said, could we be accumulating now before divesting in a lower interest rate environment? So it's an interesting concept. Is there an opportunity, if we're using that crystal ball, to accumulate in the higher interest rate environment, depressed commercial properties, buy them, leverage them, arbitrage them into residential or mixed use, or chop them into smaller units, and then as interest rates come down and the property price go up, divest them? Is that a sensible medium-term investment strategy? However, I want to caveat, all of this has so many other interrelated pieces to the pie. Interest rates going down does not mean property will automatically go up, okay? Because if interest rates are going down quickly, it could be because the economy is going to recession. You're trying to stop or cushion that recession. If you're into a recession with massive job losses, people's income diving, as a national figure, we're not going to suddenly see an explosion in property prices. You're going to see, at best, a huge amount of interest rate cutting, QE coming out to cushion the whole thing. And if we go back to 2008, it cushioned and then flatlined. So we went down quickly with the credit crunch, went into the QE environment, cushioned and flatlined for a good few years before we saw a recovery. So, we need to bear that in mind as well. Right. That is the case, or that is the potential scenario, actually, of the banks, the central banks, bluffing us a little bit, with the markets going, we don't believe you, right? You're coming down quickly, maybe over the pond March for interest rate cuts. Maybe here in the UK, people are starting to moot June, July interest rate cuts from where we are now. Let's just zoom out. Let's just take a breath and see where we are. So recently came out, this is the UK composite PMI. PMI is Purchase Managers Index. Effectively, this is a print of confidence from purchase managers about what is going on in the economy. And we've recently had the November figure out. I'll just draw that there with my left hand. You can see, right, we've gone up. Basically, if we're going down, here we've been going down, it basically means we're in a bad place in the economy, right? Things are getting worse. We're not selling as much, all of that sort of stuff. And there were a couple of articles, and I talked about it beginning of November, where there were projections or predictions of a fairly significant drop again. Now, there was a theory. So this was actually, I can't remember the first month that the bank paused their interest rate rises. There was an article that came out that said the bank pre-saw this projection of the composite PMI dropping significantly. I think it was in October. So they saw the stats and went, oh, the amount that it was forecast to drop was a massive leading indicator that we were going into recession. And there was a discussion point around this that the bank, before their meeting, saw this and went, right, we cannot raise interest rates anymore because we're about to get to the tipping point. However, the projection was complete BS, right? It was completely wrong. And actually what happened, I think it was the September to October one, is it actually ticked up slightly. So rather than diving completely, I'm just trying to look at the scale. I think they were talking about it going down to something like 46 or 47, which you can see if we had actually gone from here down to about there, we would be, sorry, I've got too many lines on this now. We're doing a serious drop. It went up. Then in October, it ticked up again. In November, we've had a decent tick up, which means there's more confidence there in the market, which is interesting. So these I feel we've actually seen quite a lot of headlines, doom and gloom headlines about the economy. This composite PMI kind of shows the opposite to that there's confidence right now in that. That will be a concern for interest rates, because if we're seeing strength, this goes into the narrative of higher for longer. Okay, what else can we see? This was an article 3 days ago. Again, a lot of people over the pond are looking at the labour market in the US going, oh, wow, actually, it's looking pretty bad. And this is why there's been a bit of a frenzy about the interest rates. So it's been looking like poor job market equals we're tipping into recession, equals interest rates are going to be cut quicker, equals bond traders having a bit of a frenzy, right? Driving down, yields go down, bond values go up. So that's what's been, a lot of that has been being caused. Today, the headlines, US economy adds 199,000 jobs in November. So the November jobs report came out today, right? And all of a sudden, all of that doom and gloom about, wait a minute, we're slipping into recession has been swiveled. What does that mean? Bond traders to face a reality check with Friday's jobs report. Okay, so effectively, have people got a little bit ahead of themselves here, thinking that these interest rates are just going to start getting cut? The answer is I do not know. I do not know. But the data over in the States is that the jobs market is pretty strong, right? So that's not indicating recession. The UK PMI composite is looking pretty strong. That's not indicating recession. In the UK, we're still seeing strong wage growth. Okay, it looks like it's probably peaked, but it's still strong nominal wage growth. We've seen this very, very tiny uptick in unemployment, but how accurate is the data anyway? Because there's been such a low reporting. I don't know. So it's the question is, the bank are using this data, and the bank is seeing things and saying, look, we're going to have to keep these interest rates up for longer. We talk about CPI. The next print will be out, I believe, next week. I think this quarter we're going to see some when I say this quarter, we're not in a quarter. December, January, February, I've said it for a while, we're going to see some actual systemic sticky inflation now come out in the data. Because when you look at CPI in itself, if you go December 22, January, February 23, there's only a net 0.2% increase in CPI, right? I think off the top of my head, we've got 2 plus 0.4% months and 1 minus 0.6% month. So it's a net plus 0.2 over the quarter. That data is now going to feed into the current December, January, February prints. And if we have any sort of month on month increase above 0.3, 0.4 average for the next 3 months, we're going to see an uptick in CPI, right? That's going to cause concern. So we've got a lot of conflicting messages coming out at the moment about where the direction is going. So what do you think? There is just a caveat, because I have talked about the US jobs market. Okay, I have talked about all of this stuff is from over the pond. It's important to understand that the American economy is very different to ours right now. Okay, this is forecast next year for US. This is us. So about 20% of the US. When you look at GDP, theirs has been on an uptick. Ours has, Blue Book 23 put us on a slight uptick, but in reality, we're flatlining. So we have to be careful about making direct comparisons between what's going on here and what's going on in the US. We can't just say we're 6 months behind the US, so everything that's happening there is a crystal ball, and we're going to see it here in the UK. Completely different kettle of fish, right? Inflation is less over in the US. It is more sticky here in the UK. When we see the headlines for the jobs market, this has just come out. UK employers limit hiring permanent staff amid economic stresses. Okay, if we look at the vacancies data that has just come out, well, I say just come out, this lags behind, but this is the number of vacancies in the UK. You can see a very clear downtrend. So I would say UK economy is looking way more fragile, okay, than the US. Does that actually mean we're going to go into recession and see those interest rates come down more quickly? I don't know, but that's what I wanted to talk about today. So I'm going to hand it over to the forum and see what everybody else thinks. What are your thoughts on that, on those hypotheticals as a discussion point? Let me know your thoughts. I'm going to go through some of the comments now. So let's see. Fastdale, by the way, give me a thumbs up if that was of use, if that stimulated some grey matter. And actually, before I go to some of the comments, I still categorically believe, and I'm still doing it myself, that commercial or mixed-use property in its current way depressed state, arbitrage it to residential or smaller commercial is a fantastic opportunity for those property investors who are in there. We just need to find it. We need to negotiate it. We need to know how to structure these things and how to turn it around and make use of that value arbitrage. If you want to have an idea about how to do it, I do have a white paper. Sorry, Foster, I'll put your comment back up in a second. Please go and download this if you are interested in investing in what I call property cash flow multipliers, which are, I would say, unicorn properties where we can buy at a extremely depressed rate. We can add a huge amount of value, recycle funds, and get a massive amount of cash flow. I call them the PCMs, property cash flow multipliers. robstuartglobal.com/white-paper gives you my strategies for doing that. It's totally free. It's about a 30 to 40 minute read. And if you want to get a physical copy, you can get a physical copy as well. Okay, right, let's get back to Q's before I shut up for the long weekend, which is my birthday. So I'm being treated and going out this evening, which I'm looking forward to. So no offense, but it's been quite a busy week actually, especially with all the stuff we've got going on in Chester. Right, Fastdale. Do you think the expectation of rate cuts being perpetuated by the media who repeatedly advertise mortgage rate drops every day when in reality they've only dropped marginally? 100% Fastdale. I completely agree with your sentiment there. It's why I like to get through the nonsense that the mainstream media put out. I'm just going to look quickly if I can find the graph I put up last week, which showed actually what's happened with average interest rates. Can I find it? No, of course I can't. When I actually need something, I can't find it. Put up a graph. Put up a graph last week of actual average interest rates for 2 years and 5 years. And they have come down, but it's not like there's something crashing down by any stretch of the imagination. Whereas you would think sometimes when you read mainstream media, actually, when you look at a lot of other people in the YouTube sphere as well, that enjoy that sensationalist sort of thing. They'll pick one mortgage rate that is for existing customers on a 60% minimum loan to value with a 5% fee, and they get the headline rate of 3.5% or something, and go, look at this, we're getting great rates. That's not a typical rate right now. So I do agree, but it's also worth noting that they have come down from the highs of where they were as an average. So there is a definite average drop. But to tie the loop off on this one, as we reverse, which we will do at some point, right, into a lower interest rate environment, exactly the same factors that we've been talking about with the interest rates going up will happen when we go down, and that's the lag period. So as we go up, as interest rates go up, people who are on fixed rate deals will be sheltered from that until they come off their fixed rate deals. And we still have a huge amount of people coming off cheap fixed rate deals over the next 12 to 18 months, right? You think everybody who fixed on a 5-year fix in 2020, 2021 are still on that fix and they're coming off. And next year, there's still over 1 million, I think it's 1.6 million people coming off cheap fixed rate debt in 2024. So even though they're coming off and they're not going to go onto a variable rate that we saw over the summer, which is, whatever the highest, swap rates were, 6% for a 2-year or whatever, was it 7% for a 2-year? They're still going to be coming on something that's extremely higher than they've been on for the last 5 years. So just because they come down slightly at the top does not mean we're still not going to see this massive increase. It just means they're going from there to there rather from there to there. So when you look at that on a macro level, right, you're still going to see this a big impact. Although something I was going to talk about this week, but we've run out of time because I thought today was more important to talk about this narrative of rapidly dropping interest rates. The latest quarterly Bank of England stability report has just come out, and actually the DSR, which is debt service ratio for the country as a whole, has actually dropped from where it was last quarter. So that's effectively the bank saying the impact is not going to be as much as we thought because we're expecting interest rates to come down quicker than we maybe expected. Well, that's not the bank saying we expect them to go. Just a caveat, that's not the bank saying we expect them to come out. It's whoever's written the report say we think they're going to come down because they already are coming down. The swap rates are coming down more quickly than expected. However, to finish this one, as I said, as they come down, you're also getting at people who are fixed on higher rates who will not benefit from it coming down. So they'll be fixed on higher for longer. And the other thing is we might see this short-term drop, but it's the short-termness is not the big factor. It's where they settle and for how long. So I've said, I don't care if interest rates peak at 5, 5.5, 6, 7. It's not about where they peak. It's about where they end up for the amount of time they end up, right? So if they peaked at 6, if they went to 6% and then came down versus 5% and then come down, it doesn't matter. If they then settle at 4.5 for the next 10 years versus settling at 2.5 for the next 10 years, if that makes sense, that's going to have more of an impact on the property market, certainly in terms of real prices, than the actual peak figure. Okay, I hope that makes sense. Okay, let's go to the next question. Does that answer the question fast, Dale? I'll just scroll through. Mayowa, I think we're due a strategy call, aren't we? Interest rates remain at their current rate until early 2025. Interesting. I like it. Bearish scenario. I do think they will come down in 2024. I do. I don't think it'll be by a lot. Stafford, interest rates to the UK. Let me put this up for Stafford. Interest rates to the UK, there will be nothing in the figures to drop out like last month. Energy up in Jan, rates to be flat for at least 6 months. And we're talking about inflation here. And I agree with Stafford about this. So last month there was a massive, skews not the right word. It was an anomaly in terms of the CPI data with the energy figures coming out and going so negative. That really skewed it. Just as I said, and you probably put that in, Stafford, as a question before I talked about my thoughts. When you look at the next quarter, we're not going to see any drop off in inflation. If we have anything in the figures come in terms of month on month over the next 3 months, we will see an uptick in inflation over the next quarter. Whether that's transitory or not depends on where we go into 2024. Interestingly, crude has come down, but energy prices have gone up. So we are very fragile, and I think we're very susceptible to, again, a black swan event or something that's out of our national control, like geopolitical issues, like Middle East, like Ukraine, and we can see something like that will tip us over the edge. Is my thoughts. Okay, let's see what else we've got in terms of questions. Sorry, I'm just scrolling through. PSR, strong wage growth, relatively low unemployment economy, which is correcting but not crashing. Where are forced sellers coming from to cause a deeper house price crash? Very good question, PSR. The answer is right now, they are not. Which is why we are not seeing a deeper crash, because there are no forced sellers, or there are very few forced sellers. In the residential property market, okay, there are loads of forced sellers in the investment, in the buy-to-let market and in the commercial market. That's where the opportunity is. If anybody is in the investment space, retiring, baby boomer, buy-to-let landlords, right, who are exiting, and institutions, funds, and indeed private owners of commercial property who are exiting, okay? So we have seen a huge correction in commercial. I believe we are seeing a correction we're seeing a lot of value, a lot of opportunity in the buy-to-let market. Maybe not with your bog standard 2 up, 2 down, but certain aspects, certainly bigger houses that people have maybe bought and over leveraged, and so with the significant debt they've got on those buy-to-let assets, they're no longer able to service their debt with the rent, even though the rent's gone up a lot, so that does help. But you're right. It's why I have said and still say I do not see at the moment on the current data. I do not see a meltdown. I do not see 35% nominal price drops. I see peak to trough 15 to 20% over probably a 3-year period is my prediction. Lovely. Ian, very, very much thank you for your the birthday wishes. Sean, let's put this up. If we see a sudden reversal of interest rates, what would happen to government bond values? First-time buyer with a license that's largely a defensive portfolio with lots of government bonds. So if we do see a reversal of interest rates, then bonds are going to go up in value. Now, I am not an expert. I've got to be honest. I know a lot about property. I do not know a huge amount about the intricacies of bond markets, but just in my pea brain with my simplistic thoughts, then bond value should go up if the interest rates reverse, right? And when I say interest rates, it's the yields, the gilt yields, treasuries, gilts. That's what we need to see rather than the central bank interest rate. Which is why over the last few weeks we've seen, those yields have started coming down, or they came down quite a lot on the expectation that the interest rates are, going to come down more quickly. That will put bond values up. Yeah, there we go. Or I say bond values up, so they'll be more expensive. Interestingly, so if we just flip back here, let me just take, sorry, Sean, I'll just take your comment off so we can see it. It's exactly what this author is saying, that you can see here, the case for locking in yield has grown stronger, which basically means he's saying, right, now's a good time, rather than hold off, now's the time to be locking in your yields, because then the lock-in yields and then the bonds are going to go up in value as the interest rates come down, right? I'm not going to go into the intricacies of, some people think that's counterintuitive. If you lock in a yield now, right, and then interest rates go down, which means future bonds, right, interest rates going to be lower, it means your one with a higher interest rate is going to be more valuable, right, basically. So lock it in now, and it's going to be worth more. They're saying, don't wait around, get in, now's the time, because there's not going to be a lot more upside on this. Right, don't know if that answers the question and what your thoughts are on that, Sean. Tour Rhythm Golf, like your trend line analysis on Halifax HPI. Yeah, we've got to watch that channel. Robert West, how you doing, Rob? My feeling is that interest rates may start to come down as early as February. Oh, interesting. In the UK, do you think that, Rob? Landlord with mortgages are getting out as quickly as they can. I think the general public are struggling to live. This is what I mean. I think just by being on this live stream, we've had opinion from February next year to basically February 2025. I think there's a lot of uncertainty, isn't there, at the moment in terms of which direction we're going with this. I'm going to put my flag in the middle. I've always said August, September next year. So let's just see where we go with that. But I do agree. I think people are struggling to live, but nominal wage growth is still pretty strong. Okay, we'll take one more before I sign off. Oh, that is the last one anyway. Fantastic. Rob says the cost to build a house increased massively. Labour, materials, the ever-increasing red tape means developers aren't building. I don't see how they can crash. Supply, demand. Yeah, I think we are at the moment struggling to see scenario or the factors for a crash, because there is a constriction of supply, there is a lack of forced sellers, right? That means we're not going to see the crash. If you remember, I say there's three things that are going to cause a proper big property crash. Rise in unemployment, negative equity, and affordability. We're definitely in an affordability issue. Okay, that's been there for ages, and that's why people think there's going to be the crash. We have some people in negative equity, but actually, we're not in a huge amount of negative equity. And there's also a lot of forbearance from the banks, right? Majority of banks have signed up to this charter of not doing any repossessions for 12 months, gives people breathing room. The big one is the unemployment, and we can take the data with a pinch of salt. Nobody really knows, because I don't trust the unemployment data, but it doesn't feel at the moment like we're in a horrific high unemployment environment with everybody going to the wall. That said, that trend could easily change depending on what happens with interest rates. There we go. I'm going to tie it off there, team, because I feel it's time to go to dinner soon. Tor Valley saying, cash value on my pension pot, very bondy, up 5% in the last few weeks. There we go. Interest rates or yields come down, value goes up. We'll do another session on bonds another time to, again, talk about that inverse relationship. Right, team, I hope that's been useful. I think next week CPI data is out, so we'll be crunching the numbers on CPI data. If anybody's got any questions, get them on the recording and I'll chat to you about it. Please do remember to subscribe, help me grow the channel, reach more people. I had lots of people say, we're surprised by how low the your subscriber base is, Rob, based on the content. I really appreciate those comments. It really means an awful lot to me. It is the way YouTube works. It's the way the algorithm works. They do not just suddenly give you loads of reach. It's a case of consistency, which is why the more consistency and the more people who engage, subscribe, and YouTube goes, people like this channel, the more reach they'll give. So we're rewarded with engagement. So please do hit subscribe, hit like, keep the conversations going. It really means a lot to me, so we can continue growing this channel. I look forward to seeing you next week, team. Have a great one.